This is the July 25 edition of Commodity Week.
Todd Gleason services are made available to WILL by University of Illinois Extension.
Welcome to Commodity Week. I am Todd Gleason. We're coming to you live from just north of Augusta, Illinois, at the Illinois Soybean Association's Tailgate Talk. This afternoon, we'll have our guest talk about the marketplace and maybe take a few questions from the panelists and the farmers that are gathered here for this event. Our thanks to Illinois Soybean Association for having us on hand. With us today is Matt Bennett from agmarket.net, along with his colleague Curt Kimmel, also from agmarket.net. Matt is in Windsor, Illinois. Curt is in Normal, Illinois. And Merrill Crowley is here from Watseka, Illinois. Made nearly a 4-hour trip to make it to this part of Western Illinois today. He is with agtradertalk.com. I'm going to let each of them give you a bit of an opening statement as it relates to the marketplace and where they believe we are today and what they expect in the near term. Merrill Crowley will work from your side of our panel. Back to Matt Bennett. We'll go ahead and get started with you for the day.
I'm more of a technical type individual when it comes to trading. I have been impatiently waiting for a cycle low to hit. It is a 26-month cycle low. We are still in the range of that low, and it was the prime target for that was the end of May, 1st of June. Right now, we're seeing a low that seems to be trying to develop. If you go back to, say, 2014, which a lot of people are looking at, it was this time of year that this market went into a sideways pattern for roughly 30 calendar days and then fell, I think about 60 cents down into the lows in 2014 for the corn and the beans, over $2 down into the lows. The good news is after we did make those lows, we saw a 22% retracement in the corn. The beans had like a 16.5% retracement higher. So even if we do go lower, there is a pretty good rally toward the end of this year. But the other thing going on with these cycles is that we have a 22-week cycle coming due, and it came due actually today. So if the low did come in like I think, then that would correspond to the 26-month low, and that would strongly suggest that we have a bottom in the corn market. Of course, if we violate 403 by, say, 10 cents, that kind of negates that. It's one of the things about cycles you never really know for sure, but that's kind of what I'm looking at is I'm kind of getting a little bullish for the corn. The beans have some more things to teach me yet as far as setting up a low, but it won't probably get too far away from the corn.
Yeah, great to be here. My name's Curt Kimmel on Fag Market, and we're out in Normal, Illinois, and it's always great to be able to come out and see everybody in person. Spend a lot of time on the phone, do a few farm visits, but no, just a little add-on to Merrill's technical observation there. Brian Split, he's one of the partners of Ag Market. He does an excellent technical video every Wednesday afternoon, and he's been right on the analog year of 2013 into 2014. And looking at the market action, yes, I think we got a kitty cat bounce here. Not much of one, but one observation he's been pointing out is in that particular year during the month of July, we had some volatility, some ups and downs in here. But the main theme is you start getting optimistic, guys. Take advantage of it and get caught up to where you want to be. Our best advice right now is to use this little bit of strength we're seeing here is get to where you want to be. Defend the $4 level on corn. There's some options. It's fairly well priced, and defend this 1040, 1020 level on the downside on beans. What I'm most fearful of, you go to moreresearch.com, and the reason I bring that is they do a lot of studies, seasonals, and so forth. But if you pull up the long-term charts, corn and beans, you can go clear back to the 70s. What you'll see is in the last couple of years is kind of mirrored in the past. You get 2-3 years up, and all of a sudden you come down. Every once in a while you'll pop back up. But there's a definite trend. When you come down like this, you can maybe spend 1, 2, 3 years building another base before your next rally. So hopefully we're not in that scenario where we'll be in a 350, 450 trading range, because we need more than 450.
Along with us as well as Curt's colleague, Matt Bennett from agmarket.net.
Yeah, I mean, I just try to add a little bit to what these guys are talking about. When you look like at the December continuous chart, basically we set up a head and shoulders pattern, which projects to, I believe, south of 250. I don't think that's going to happen. There are some reasons, obviously, that this market gives us that it's concerning. I was on market to market 2 Sundays ago. My dad told me I was a bearish. Use the adjective of your imagination whenever I talked to him the next morning. Because I said, you know, if you're selling old crop corn, if you're selling new crop corn, chances are, if you're selling it today, you're not making much money, if any. I understand that. I mean, we put $1,100 into that 2013 crop, 2014 crop, really wasn't any cheaper. I mean, I'm concerned with 2014 inputs right now. I mean, I look at fertilizer prices. It concerns me, especially with 450.25 corn. So, you know, I think there's a handful of things that are concerning. I think as a grower, though, you've got to understand how all this works. If you know, I was asked on a program this morning, would you rather be a grower that has a huge crop, an average crop, or an insurance crop? And I think that the person that's going to make the least amount of money this year is an APH yield. That's all there is to it. So if you're an insurance, and I don't think anybody is, looking at the color of everything here, you know, then you've got to understand that the farther you are from 466, the better your insurance claim. I've been telling people this that are in those situations. If you're a grower with a lot of bushels, don't tell me that you're going to make really good money this year unless you've done some hedging. Okay, so I got to know what my previous hedging already has done to my break even moving forward. I think a lot of folks are in that, unfortunately, 440 to 460 break even for the 2024 crop. Obviously, we're not looking at prices like that right now. So I did the math the other day with Scott's numbers, Scott Irwin's numbers for all of the costs. This is through FBFM, so these are actual numbers. His cash rent was $358, and I just lowered it to $300 just to try to be nice. And that day, at $374 fall delivery corn, which is what my local bid was, it take 286 bushel corn to break even. So I'm not trying to be depressing. I'm just talking about what I'm seeing. So as a grower, I've got to understand, you know, I think that our goal this year is more about balance sheet preservation than it is building. But that's just my opinion.
Merrill Crowley, when you think about the important parts of the fundamentals this year that you've been watching, whether that's on the consumption or the supply side, what makes the biggest difference for you related to where price might be headed in the future? And I know you do the technical side as well, but fundamentally, where do you look to find some of the answers when you're talking to producers?
I try to look at things that I know from history. As we came over here, I was absolutely amazed at the number of trucks we saw on the road. And that usually tells you that a lot of farmers that were holding grain gave up. Now, if they're holding grain and they didn't get anything sold there, or they still are hanging on to it, trying to sell the last 20% or whatever percentage they have, they're certainly not going to be looking at the new crop. So that makes me concerned of where they're at with the new crop. Some of the things I look at is just like the history. When farmers have a lot of grain, 3 billion bushel according to USDA on farm, then you're probably not going to see the market rally too much. But then you get to the point and you say, how much lower can we go? What in this information that we're seeing now, for example, the yield, there's people talking yield clear up to 184 bushel an acre. How much bigger can it get from this point? And no one knows, I know, but it just seems to me like we've reached a point where we've factored in almost everything bearish we can think of, unless somehow, some way we can get over 184. But that's some of the things I look at is basically human nature. What happens? We get these cycle lows. They tend to bounce pretty decent off the cycle lows. We do need to get over the highs that we had back in June 20th or June 28th, I'm sorry, at that report. So that's going to kind of be something I watch. I don't have any problem with anybody buying something right now. If you're a livestock feeder, it might be a good idea to buy a small percentage, say 20%, for your feed needs in case this does happen to be the low. But this is a time period, and as we've moved away from other market years. August and September have become bigger time periods for lows, and the 2014 low was in October.
You and I both worked for Dan Zwicker for a stint in our careers. I recall it. I'm sure that he taught you the same thing when he was going through some of the charting patterns with you and giving you ideas of how to pick places where the chart might be headed. Was that not only that you had to do that, but you had to come up with reasons ahead of time for why it might move in a certain direction to a certain point. I suspect you also still deploy that in some case. So when you have at these current places, what are your chart projections and what fundamental reasons do you put on them to get there?
Yeah, each technical analyst has just a little bit of different approach. But for Dan, he was known for writing a Zwicker cycle letter, and he had the cycles down to a T, and they worked fairly well. The 8-10 week cycle, but what happened was those cycles got off course here as we started to see the managed money come into the marketplace, and that just kind of distorted them. So we had to go to a 10% fudge factor either way on there, because when you see a commodity fund coming in and start tossing a couple thousand contracts around and they support their position, it flows it off. But you look at time counts, that gives you an idea. But the other things we kind of watch, and it's real popular with the funds, is the moving averages. Whenever you have a short-term moving average cross a longer-term moving average, that you also see, you have the tendency to see volatility or market activity pick up. Now, the thing about the funds is they got a trading program, but they don't divulge a secret. But how's come they're all moving the same way at the same time? So it's kind of a tough thing to manage, particularly when you're sitting there right when a crop report comes out. I sit there and see the market moving even before I see the numbers. So it's a struggle there for a while to kind of manage their position. One other thing we watch quite a bit is the divergences. They're stochastic and momentum indicators. And whenever you see the market making lower lows and the divergence start making higher highs, that's often signs of a bottom. That's what we've seen here in the corn and bean market. Now, how long that lasts, you have to have technical follow-through.
Following up with you, Matt, on some of the materials you get from JSA, I'm wondering where the commercials are at this point and where the algorithms or the black boxes of the fund money might be, and how much of a concern their positions could be as it's related to both corn and soybeans in direction.
All right, let's start with the funds. So, if you guys were watching that July WASD, I mean, that was a bullish report, period. When it comes to corn, the new crop balance sheet, the average trade guess missed it by 200 million bushels. All right, I don't remember a miss that bullish in a long time. Okay, and here's the thing: most of the time when you have a miss like that, you would trade the market. I think it's safe to assume, guys, 10 to 15 higher pretty easily, wouldn't it? Would you guys assume that? And so, but what happened on Friday of that report is that the market just couldn't really get anything going. And what did that tell me is that the funds who had built themselves into what was at the time worked into a record net shortest they've been of all time. They just weren't super interested in doing anything but protecting their position. So then you come in the next Monday down 11 cents after a super bullish report the previous Friday. It was an interesting report in that the June quarterly stocks, which is a lot, I hang my hat more on fundamentals. June quarterly stocks showed us that actually usage was down versus what we'd been planning on all along. Implied usage was 120 million bushels lower. USDA raised feed and residual usage in the July report by 75. So basically, we saw a 200 billion bushel swing in usage versus what most of us thought was going to happen. That July report was a friendly report. The funds, though, are still, in my opinion, I don't know what I would say. I think they're hesitant to go ahead and cover those positions. But I do think that this week, you just closed higher for the fourth day in a row. It seems to me that you're probably seeing some folks saying, hey, we've made a ton of money to the downside on this market. We're going to go ahead and cover some of these shorts and then kind of wait and see what happens. Like Merrill said, back in 2014, if you look at those two charts, we kind of chopped around here in July, and then we really plummeted after that September WASD. September is when you get into the field. I don't know that that's what's going to happen this year, but I think you could make the case for it. As far as the commercials go, it's interesting in that basis levels had stayed fairly strong. Over the last few days, we've kind of seen a little bit of weakening there. And I've got to think, like Merrill's saying, there's a lot of corn that's starting to move. There's give up point, if you will. I am very concerned that as you get closer to harvest, you could go from like a 15 to 20 or 25 over basis level, to something with a negative in front of that very rapidly, especially as harvest gets started within a couple, 3 hours of you. So I would be very cautious as to make assumptions on basis.
So Merrill, as he's talking about the changes in the numbers, USDA between the old crop and new crop and the S&D tables for July added 150 million bushels of usage for corn, 75 million bushels in exports, essentially saying, hey, the price is so low that we have to increase, or it's likely to increase, the consumption in these two categories. Would you agree with their assessments?
Would I agree with the USDA? Is that what you're asking me? They come out with a June report and they add, I don't know how much to the ending stocks, 200 million. And then they turn right around in July and they take them off. And they put it into a place that you can't track it, which is the feed and residual. I don't know how anybody explains that. They can explain it went into feed and residual, but I don't know how they come up with one figure in June and another figure just 14 days later. That's why I stick to the charts. And the other thing I'm seeing right now with the charts is the fact that the commercials are long. How many times have you seen the commercials long this time of year? What happens when they start going short? Do you know? Market rallies. They started selling some corn last week. We'll see if they keep that up. But it suggests a low in a market rally. So,
well, there's a lot of fake news out there, as you know. It's just amazing how it plays with your mind. I think the media or the funds have the Curt Kimmel indicator. Whenever I get bullish, they sell. Whenever I get bearish, they buy. But it's something you got to deal with. These reports are not going to get any better. They're going to have revisions to the revisions. As Merrill touched on, you've got this economic numbers. They go back a year or two and revise the numbers and so forth. But you got Matt did a lot of meetings, and the term that keeps in my head is farm for profit, not for price. So the strategy is know where you're at, break even, and implement some strategies so you can survive the next 2 or 3 years.
Whenever they give us information, it's the gospel. That's what the algorithms rate, okay? What's hard about it is that whenever I say implied usage, what happened was we ended up with more stocks on hand as of June 30th than what any of us thought. That implies that usage is lower. And like Merrill's saying, the bottom line is that they raised usage in July. So it really is complex. I had people say, well, maybe they're saying last year's crop was smaller. Well, that didn't make any sense if we had more corn on hand June 30th than what they thought. That doesn't make sense. So got to be really cautious as you approach this market, because there could be some pretty big fluctuations over the next 2 to 3 months. I'm not sure that, I don't want to be super bearish. It's just that given stocks, even with the bullish revisions in July, you're still looking at new crop stocks at 2.1 billion bushels. And 2.1 billion bushels doesn't equate to $5 or $4.50 corn. It just doesn't. Okay, so we got to understand how that works.
You got to be flexible in your marketing, and you got to have staying power. And what's going to happen this fall is guys going to be frustrated. And what I'm picking up is there's going to be opportunities. The elevator's going to offer you a free DP, and they're going to offer you basis contracts. I'm not a big fan of those at all, because you're just really turning over the grain in the commercial's hands. But on a basis, hopefully it's the widest here this fall, and I think we can narrow it up here and take advantage of the carry and just hedge it and store it. But if you're going to do a basis contract, it would make more sense to me, instead of doing a basis contract, getting 75% of your money up front, because all they do is take your grain, sell it, and buy it on the board. Once you just sell it yourself, you get 100% of your money up front and re-own it yourself. So there's going to be some creative ideas to help give you guys some staying power. It's just a matter of finding something you're comfortable with.
That $11.20 seasoned average cash price for soybeans at this point seems awfully wrong. And I want to know what these guys think about the price of soybeans and where things might move. Merrill Crowley, you get to take off from the beginning.
I don't see anything technically at this time that really points to a low in beans. And part of that has to do with if we get, let's say we get a rally back to 11, just for the fun of it. Well, who's that going to help most? What's going to help you guys? Definitely. How many more acres do you think we're going to see down in South America if that happens? The idea behind these low prices is to try to get the demand started so that we can get rid of this crop and to keep the acres from being planted. And as much as I hate to see that happen, we go through it almost every 3 or 4 times since I've been in the markets, at least. Again, we have this sideways movement. If we can hold above the lows, I think we got a good chance of maybe running higher. But soybeans, with the crop here and the fact that China is not taking the demand. They keep saying their demand is dropping. Of course, it's the USDA telling us that. But if they're right and the demand is dropping, and it makes sense because their population has been going down. So they don't need as much product. So with that in mind, if your demand is gone and the countries that compete with you can plant at cheaper prices and will plant and will expand, the support situation, in my mind, is not there at this time.
Beans are tough because right now we're looking at 450 million bushel carry out, barring no triple digits moving east, barring no Labor Day frost or freeze. The bean crop's in a pretty good situation. But Merrill mentioned China. They're just now starting to buy. The export picture, man, they're going to have to buy a lot real quick. Because the problem or the situation with beans, they're moving the logistics from the southern hemisphere up to the northern hemisphere with the boats and stuff. So we need to see that demand pick back up. In order to get optimistic beans, I think you got to take that carryout down, below, 350 million down to 300 million bushel carryout, and that's a lot of a drop. And demand's going to have to come forward. If you compare it to 2014, that fall low was 920. That's not good.
Yeah, so on beans, Curt's right as far as the U.S. balance sheet is concerned. One thing that really concerns me is the world balance sheet as well. If you look at the July WASDE, the first marketing year, which would be the one that we're in right now, we started with about 100 million tons of beans. USDA is forecasting that at the end of this next marketing year, we're going to have 128 million bushels of beans, million metric tons of beans. A 28% increase over the course of 2 marketing years is not good. I mean, it's not good at all. So what's going on? Well, Brazil's going to plant more beans for the 19th straight year, this coming year. They're not planning on slowing down anytime soon. We're clearly not planting more corn and beans in the U.S. We're losing acreage. They're not losing acreage. And so there is some challenges moving forward. I'm a huge proponent of when people ask me, a political question, typically I just don't answer it because there's a no-win deal. What I'm going to say is if we don't have renewable fuel support out of Washington, we've got some problems ahead of us, and that's the bottom line, okay? We all need to understand that, because we need to be pushing hard as what we can. And if we don't get that sort of support, we need to understand what we need to do as producers to try to navigate this, because it could be a long, cold winter for more than a year or two. And so as far as price action goes, I am a bit concerned with, beans were up today, 1080, I believe that we traded on no beans for a while. Why not book some of those? I don't mind booking some 25 beans, to be perfectly honest with you. So if Brazil does have 170 million metric ton crop this next year, as some have forecasted, I don't think you're going to be seeing 1080 beans in the next few months.
Commodity Week, of course, is a production of Illinois Public Media's public radio for the farming world. Find us online at willag.org, willag.org, where you can listen to the whole of the program anytime you'd like on demand. Our thanks go to our panelists today, including Merrill Crowley of agtradertalk.com. He's in Watseke, Illinois. Curt Kimmel is here from Normal, Illinois, and agmarket.net, as well as his colleague from Windsor, Illinois, Matt Bennett. I'm University of Illinois Extension's Doug Gleason.